I've often been asked, when is the housing market going to crash? Interest in this topic is soaring, with an April jump of 2,000 to 500% over last year, according to Google. The New York Times reports that the median price of an existing home in the U.S. was $313,000 in February. That's an increase of 16% from a year earlier. With the National Association of Realtors believing that an appreciation rate of 3 to 5% is healthy, it seems only natural for folks to think that this current market could collapse. In an April 22nd article, New York Times reported several national analysts feel that continued tight inventory in some markets and rising interest rates will have a huge effect on the decisions people make as they reorder their priorities in response to the pandemic. Various forces in the pandemic have challenged basic assumptions about the real estate market, and that has created this supercharged market. Nationwide, the inventory of homes for sale was at a record low of 1.03 million. That's a record 29.5% less than last year. According to Lawrence Yun, chief economist for NAR, this has driven down the average days on the market to 20 from 60 and created a bubble-like feeling. Here in the DC market, our average days on market is 8. However, he asserts that the fundamental factors are different. Unlike the situation in 2008, when many homeowners had adjustable rate financing that is more risky with falling prices, today the underwriting requirements for mortgages are far more strict, which means buyers are more and much better qualified than previously, and homeowners today have more liquidity and home equity than was the case in 2008. Despite an anticipated rise in mortgage rates, Mr. Yoon expects home prices will continue to rise. He predicts mortgage rates around 3.5%, which is still historically low. And in addition, there is a dearth of new construction stemming from a decade of underbuilding due to the collapse of new home construction after the 2008 crash and due to restrictive zoning and high labor costs. Large, dense cities like New York saw a drop in prices due to COVID and people leaving the city. That seems to have changed, as there are now more first-time homebuyers in New York deals than there have been in the past 7 years, and fewer cash deals that reflect lower interest rates and a turn away from investment buyers. Early in the pandemic, market watchers predicted a drain from the cities and a gain for the suburbs. However, in smaller cities such as Washington, D.C. or Columbus, Ohio, prices rose 8 to 12% last year during the height of the pandemic. It now appears that the early assumption was not correct, as both suburbs and cities appear to be up, according to Jonathan Miller, an appraiser. Another factor fueling higher prices and the concern about a potential bubble is the fact that home buyers are often in competitive situations with multiple offers written on a property. Andy Sachs, an agent with Keller Williams, reports, we're seeing houses with 20 to 30 offers on them and prices going for 50 to 100,000 or more over asking. To be able to move quickly, buyers need to have everything in order with their finances. I recommend they also research various neighborhoods that may provide alternative and more affordable locations. There's a team of professionals needed to work through the deal as well, whether it is lenders, settlement attorneys, home inspectors, or real estate agents. Make sure you have this team of experts vetted and ready to go. In order to be able to compete in this hot market, many buyers are having to waive most or all of their standard protections to win the home of their dreams. I recommend doing a home inspection before making an offer so you can remove the inspection contingency from the contract while protecting your right to know about the structure and mechanics of the home. You can also work with your lender to put your file through underwriting to get pre-qualified. Doing so will allow you to jump quickly and shows the seller that you are a serious buyer. So, is the market going to crash? It would seem that analysts and practitioners with many years of experience feel that it won't. Will this breakneck pace of competition and rising prices continue? Most likely not. Experts predict a slowing down of the market later this year and more sustainable appreciation rates of 3 to 5% rather than the current 9 to 12%. So maybe the ultimate question really should be whether or not you should jump into the market. And the answer to that is a definite yes. While it can be somewhat bruising emotionally to play the game by losing multiple offers before you get the home of your dreams, it is better to be in it now before the anticipation of the appreciation of this coming year, rather than waiting until the market cools a bit and homes are more expensive than they are now. This is Taylor Johnson with Keller Williams Capital Properties, and I'm here to be a resource for you. If I can answer any questions or consult with you on buying or selling a property, please reach out. I'd be happy to help you. Have a great day, everybody. Bye now.